So, all right. So right about 9 o'clock. Welcome everyone. Hopefully you had a good weekend. Maybe you caught the game. Maybe you didn't. Little unexciting if you did catch it. Kind of a blowout there. I don't watch much football, but I usually end up watching Super Bowl when it comes around. It's kind of a good time to just hang out with friends and family and stuff. So. Today we have Jason. He is not a 1031 exchange company. He provides solutions for um, investors who are looking to get out of being a landlord and they need to do a 1031 exchange. So he does some advising on some other options other than exchanging a property for a property, and becoming a landlord for just a bigger property, essentially, or a landlord in a different state. So he's got a pretty interesting topic here, something that I'm not super well versed in as far as these DSTs. So I'm going to go ahead and turn it over to you, and let's see how this works. Good morning, Jason.
All right. Good morning, Travis. Thank you very much. I appreciate that.
Yeah, not a
Um,
problem.
so, by way of introduction here, I'm the founder and managing partner of a company called 1031 Capital Solutions, and we are private equity advisors that specialize in helping people exit retirement their rental properties when they reach their retirement years. So we have I'm going to turn off my camera here so that you can see more of my screen. So
Okay.
we've done over $300 million in transactions over the years. And we're one of the top providers of a solution that I'm going to talk about today called a Delaware Statutory Trust, or DST. And we're one of the top providers of these DSTs in the country. We have more than 50 years of combined experience, and we have access to the entire inventory throughout the United States for these types of investments. So our process is that we do very rigorous due diligence on these investments, and I'm going to go into what they are and how they're structured in just a moment. But we evaluate them very carefully and then make recommendations that are in our client's best interest. I'll show you how we do it, but we use a very narrow financial planning process when we're working with our clients. So we almost act like a financial advisor, but only as it pertains to doing a 1031 exchange and ultimately investing into a passive real estate program. We're very education focused. I do a lot of talks like I'm doing this morning. We also have an open website that has all kinds of great information. There are fact sheets and brochures and short videos and long videos and recorded webinars and all kinds of educational information around 1031 exchanges and around rental property exit planning and various investment strategies. I wrote a book with the co-managing partner of the company, Rick Gann, and the book is called How to Retire from Being a Landlord. And this can be a fantastic tool for you as agents to learn about or go into more detail about what I'm going to talk about today, which is this enormous market, this enormous opportunity that exists right now, particularly in California. It's really all over the United States, but it's much bigger in California. And so this book explains that opportunity. And it's also potentially a fantastic way to start the conversation with somebody that you've identified as a prospect, and you can give them a copy of this book. So I'm happy to give you free copies. I'll show you how to order them at the end of this webinar. You can get one for yourself, or you can also get some for any prospects that you want to give them to begin the marketing process. So what is a DST? What is a Delaware Statutory Trust? I'm going to explain what this is first, and then I'm going to explain why you as a real estate agent should care about what a DST is and how to leverage your knowledge of DSTs to get listings from a very large and underserved segment of the market. And then finally, I'm going to talk about what tools you need, and I'm going to give you those tools. So that's kind of the agenda for today's call. But first and foremost, what the heck is a DST? A DST stands for Delaware Statutory Trust, and it's literally a trust drafted in the state of Delaware. But for your purposes and investors' purposes, Just think of it like a fund. Think of it like a mutual fund, except where mutual funds typically own a large basket of stocks, these DSTs are a fund that typically owns a single property. So it might be a 300 unit, a brand new apartment building in Denver, Colorado, just as a random example there. And that fund only owns that one apartment building. And there might be 100 or 200 individuals that did 1031 exchanges for their property into this fund. So the way it might work is somebody owns a $1 million property that they've owned for 50 or 20 years. They've rented it out for a long time, and now they don't want to own it anymore. They don't want to pay tax, so they do a 1031 exchange, and they don't want to buy another property. So they will exchange their $1 million into this $100 million apartment building, and they own 1% of it. So that means they have a right to 1% of the monthly cash flow, 1% of the total appreciation. They maintain all of their tax benefits. So it's identical to owning property in every way. The difference is you only own a fractional interest of a large property as opposed to owning 100% of a smaller property. So the number one reason that people invest in these structures is because they want to get out of the business of real estate. So this is not a good strategy for somebody that's in their 30s, 40s, 50s, that is out accumulating property and building their real estate empire. That is not what a DST is for. A DST is for that same person 20 or 30 years later, where they've built an empire. Maybe it's a single property, or maybe it's 5 or 10 properties, but now they're at a stage in life where they don't want to deal with property managers and tenants and refinancing loans and maintenance issues and all of the rent control and just cause laws and all the red tape that California is just piling on landlords. They don't want to deal with that stuff anymore. So they would love to sell their property today, but they don't because of the tax bill. So that's really what the DST is all about. It's important to note that 21 years ago, the IRS took a look at the structure and said, yes, this absolutely qualifies. They issued a revenue ruling. So this is very clear ground that we're working on here. This isn't pushing the envelope or experimenting. This has been a strategy that has been effective for more than 20 years and has been approved by the IRS. All of the DSTs that are out there are very large institutional properties. So you don't see like a duplex or a triplex as a DST. If it's residential, it would be a 200, 300, 400 unit apartment building, or 100,000 square foot industrial property, or hotel, or office, retail, student housing, senior living. These are large institutional style properties. Most DSTs are a single property, but some DSTs might have 2 or 3 or 4 properties within a single DST, allowing the investor to get diversification with a single investment. One of the great benefits of these structures is that if somebody has a loan on the property that they're selling, they do not have to get a new loan in the DST. It's all taken care of through the DST, and it makes it very simple and easy to own. And whatever amount somebody has, so let's say somebody sells a property and they end up with $642,927, right, from the net sales proceeds. They can invest that exact amount into a DST, and it's going to purchase them a certain percentage of the DST. That means they don't have to go out and find a property that is exactly that price or close to that price, which makes finding replacement property quite difficult because your universe of properties really narrows based on how much cash you have to spend. But in a DST, you can go into any DST with any amount you want, and it's just going to purchase you a certain percentage. Some DSTs are structured to hold the investor's equity for 5 to 10 years. And then when they sell the property, they return the money back to the investor, and they can either do another 1031 exchange, or they can take the funds and put them in their bank if they want and pay tax. That's their choice. Other DSTs are structured to automatically convert into REITs. real estate investment trusts. These are large portfolios of highly institutionalized commercial property across the United States. They're professionally managed and they have liquidity provisions. So if you choose that strategy, your DST would automatically convert into a REIT. And then down the road 4 or 5 years, if you've got $1 million in there and you want to pull out 50,000 or 100,000, or if you want to pull out all of it, you just sell your shares when you want to. So both structures are available and the client gets to choose what they want to do. But regardless of which strategy the client chooses, it's a very quick and easy process. There's not a loan approval process. As I mentioned, the loan's taken care of by the DST. There's no escrow process for the investors because the property's already been acquired by the DST. So the entire due diligence and escrow and loan approval process is already done by the time the investor looks at it. So an investor could look at a property, they can look at the appraisal, the inspection, the rent roll, the financing. They know exactly what the cash flow is. They know exactly where the property is, and they can look at all of that in a couple hours as opposed to days or weeks to evaluate a property. And in DSTs, the fees, all of the fees and expenses related to doing the due diligence on the property, arranging financing, closing escrow, property management, asset management, bookkeeping, all of those expenses are built into the price of the DST. So when an investor invests in a DST, they have no more out-of-pocket expenses for any of the operations of the property. Everything is done at the DST level. The DST is going to go out and collect rent from the tenants, and then they're going to pay all of the operational costs, the taxes, the insurance, the mortgage, everything, and then pay the net amount monthly out to the investors. So it's really a fantastic solution for people that want to retire and just have the potential for income and appreciation without having to manage the property. So that takes me to the opportunity here. Well, let me back up. There's one thing I didn't mention that's kind of key to all this. These are private equity investments. They're securities. So they're regulated by the Securities and Exchange Commission. Therefore, to offer them to clients, you have to have a securities license. It doesn't work to have a real estate license. You have to have a securities license. Now, I give talks like this all over the country all the time. It's extremely rare for a real estate agent or broker to have a securities license. So why am I even talking to you about this? If it's not something that you can offer clients, then why am I talking to you? What's the benefit to you? And here's what it is. In California alone, today there are over 1 million rental properties that are owned by people over the age of 60. 1 million properties in California, rental properties, that are owned by people over the age of 60. And the reason I point this out is because people that are in their 60s and 70s and 80s have a different mindset than people in their 30s, 40s, and 50s. The people in their 60s, 70s, and 80s are looking to simplify their life. They're looking to get more freedom. They want to travel. They want to spend time with their grandkids. They want to relax. They want to golf, do whatever their hobbies are. They do not want to drive over to their rental property to fix the toilet. They do not want to have to mess with refinancing loans or fixing roofs or going to industry meetings to find out what new crazy laws and regulations California is implementing this time. They don't want to have to deal with the rent control formulas. They want to retire. And there are 1 million of these properties in California owned by people that are in this group. Now, it's not always the case. Every once in a while, I'll talk to somebody in their 80s that this is what they do. They love getting up and going and checking on the property, and okay, fine. But the vast majority of these people don't want to own these properties anymore. They absolutely don't want the property, but they think that their choice is either to keep the property for the rest of their life and deal with it, or sell it and pay a huge tax bill. And they really don't like paying tax. One of the reasons people focus on real estate throughout their lives is because it's a great way to generate income and appreciation in a very tax efficient manner. And for them to go out and sell the property and potentially pay a third of the capital gain, 30 to 35% of the capital gain to the IRS and to the state of California is just not palatable to them. They just won't do it. And this is where the opportunity is. Because even though this is true, even though this is a huge segment of the population, even though they have highly appreciated assets, and even though they don't want to sell their property and pay tax, they want to sell it, but they don't want to pay tax. Even though all of those things exist, there are not many people that help this group. There are real estate agents and brokers that help larger investors that are investing in apartment buildings and things like that. There are people that focus on selling single family residences, a family of four type of thing. But there just aren't a lot of agents that have the knowledge, the marketing plan, the analysis tools, and the team in place to help these people. So there's virtually no competition whatsoever. It's remarkable. There's this huge group of people with a huge problem. They want to sell their property right now, and nobody's helping them. And so what I want to talk to you about for the rest of this call is, how can you help them? What is it that you need in order to go after this market? And it's not a lot. The first thing really that you need is knowledge. And that knowledge is starting right now. But after this call, you might forget a lot of the stuff or not feel like you totally have all the information that you need. My website, 1031capitalsolutions.com, has a resource page. That resource page has fact sheets, brochures, recorded webinars, a digital copy of my book is there. All of the information that you need is right there. 1031 exchange basics. All the information is there. And really, this brochure that's in the middle of the page here, Delaware Statutory Trust Basics, that takes about 10 minutes to go through. If you read that, you know 98% of everything you'll ever need to know about DSTs and 1031 exchanges. There's not a lot to it when you really get down and study it. But a lot of people simply lack the confidence. They don't know what they don't know, and they're just kind of worried. But gaining that knowledge is the first step. Once you understand the basics of 1031 exchange and you understand the basics of how these DSTs work, you don't need to be the pro. Remember, you're not actually offering it to the client. We're offering it to the client. You're just recognizing the opportunity and beginning that conversation. So you really only have to know enough to begin the conversation. And that leads me to the next thing you need, which is a marketing plan. Now, some people will tell you, and this is true, you can go to a title rep and you can say, this is my farm area. I want a list of all the non-owner occupied properties that have been owned for more than 20 years, that are worth more than $1 million in value, and where the owner owns more than one property. That is a fantastic list to go to. The fact that they've owned it for more than 20 years means that the owner is pretty old, probably, unless they bought it when they were 20 or so, right? So they're probably in the retirement years. It's over a certain value, which means it has a lot of appreciation. They own multiple, which means their head's probably spinning from all the new regulation. So it's got all of the things that you need. And depending on the list that you can get, you can do mailers, you can do postcards, you can do emails, you can knock on their door, you can do whatever you want, right? But I highly recommend not doing that as your first step, because there's a much easier way to begin penetrating this market. And it's this. If you as an agent have been in this business for any period of time, you probably have some clients that are over the age of 60. If not, you have clients who have parents that are over the age of 60. You may have friends and family of friends, and all sorts of people in your network that own these types of properties. And all you have to do the next time you're talking to them is ask a couple of very simple and honest questions. The first one is, I don't think I've ever asked you before, do you own rental property? And if they say yes, you can say, and this is an honest question because there's so much going on right now that it's a reasonable question to ask. What is it like being a landlord these days? And if they say, oh, it's great. I own 2 properties and the tenants have been in there forever and I love it. Okay, well, that's not your prospect, right? But that's probably not how that's going to go. If you say, what is it like being a landlord these days? and they go, oh my gosh, I can't keep up with the regulation. Now there's rent control, and now I can't remove my tenant because of the rent control. And I've had a squatter, and I got to refinance the loan. And they just complain about all of these things. Your job is just to let it go. Just let them keep talking, get all of that stuff out. And when they stop, you say, well, I think there may be a solution for your situation. Did you know that you can sell the property and not have to do a 1031 exchange into another property? So you can sell the property, not pay any tax, and not have to buy another property. Would you like to learn more about that? And if they say yes, that's what you're going for. So we can then come in, I can do a call, I can do a meeting, I can do a Zoom, whatever, and I go over all of the details. And when I go over all of the details, you're sort of their advocate, you're on their side. So you're not pretending to be the pro, knowing all the nitty gritty, but I go through everything. And if they decide that this is right for them, and by the way, just full disclosure, I'm not going to try to sell them. I'm not going to try to convince them it's right for them. DSTs are a fantastic solution for some people, and for some people, they're just not. And so all I do is lay out the pros and cons. This is what it is. These are how the fees work. This is how the liquidity works. This is how the control works. These are the potential cash flows and appreciation and all that kind of stuff. And if they decide that this is a good option for them, the first thing they have to do is sell their property with you. You get the listing on that property that nobody else even saw. Everybody's looking for the family of four that needs a bigger house or relocating or whatever. There are not people knocking on doors of the 65-year-old people that own rental property. And so they're going to work with you if you've done a good job, because they can't get into the DST and retire from being a landlord and have the simplicity in their life if they don't sell their property first. So that's where you benefit as the agent, is you go from waiting for an event. You go from waiting for somebody to come to you and say, hey, I've decided I want to sell a property, to going out and creating the need. You educate the client, which creates the need for them to sell, and you're the one that gets that listing. Let's see. Another important part of the process is analysis. So this is software that we created internally for our own purposes, but we've also made it free to real estate agents that want to work with investor clients. So this software is designed to do a cash flow analysis, an estimated tax analysis, a cash out analysis, and an exit NOI analysis. So these tools, I'll show you how to get these, and I'm going to show you very briefly how this works, but it's designed to help the client understand what their current cash flow is and figure out kind of roughly what their tax liability would be. Now, we can do all this. We do this all day, every day. But what we learned is if we put this tool in your hands as the real estate agent, it really elevates you as the professional and sets you apart, because what you don't want to do is educate the client on what they can do. And then they go, great. And then they call their brother-in-law to sell the property and you get cut out of the deal. So in meeting with them and talking to them, you really have to set yourself apart and be the professional. So we can run this analysis, or we can put this tool in your hands and then we can help you run it for the client. I'm just going to walk through a simple example here. One of the things that clients need to know before they sell their property is what is their current cash flow on their property. So they know if they were to sell it, pay all the transaction fees and expenses and commissions and all that, and then reinvest into a DST, what's going to happen to their cash flow? Is it going to go up? Is it going to go down? Is it going to stay the same? A lot of times people are willing to take a reduction in their cash flow because it's so much more convenient and so much easier to own. But the truth is, more times than not, when they go through this process, their cash flow doubles. It goes up. And so they don't know that unless they do this type of analysis. But what we do here is we say, okay, what's the client's name, the address of the property, what state are we dealing with? And then they're telling us what is the estimated value, or we're getting it off a broker's opinion of value or whatever. So what is the value of the property minus all the closing costs? We plug in the loan balance and the loan payment. We get down here to look at the rent. How much rent are they collecting, and then what are all the expenses? And we plug in for all the expenses here. Some things that people often don't calculate themselves. Well, first of all, if somebody has an apartment building or they have a pretty good property manager, they might have some version of this already. But people that used to live in a house 15 years ago and then they moved out and now it's a rental, they don't have something like this. They very rarely keep a spreadsheet that is very accurate. So they really don't know what their net cash flow is. And when they do, they never calculate their own personal hours. So if they spend an hour a month, they don't count that. They spend 5 hours a month, they don't count that. We count it. We count the mortgage, we count their personal time, we count taxes, insurance, and vacancy. This one is huge. A lot of times people will say, well, it's a single family residence and there's a family living there, so it's 100% occupied. And so when they're counting up their cash flow, they're not accounting for the fact that at some point in the next 10 years, that tenant is probably going to move out and it's going to be replaced with a new tenant. And when that happens, you have lost rent, you have make-ready costs, you might have leasing commissions, and so your cash flow goes down, and that needs to be accounted for in today's current cash flow. The other thing that they often forget is, I'm getting great cash flow today, but in 5 years, I'm gonna have to put on a new roof, and that's really gonna affect that year's cash flow. Well, yeah, we need to back into that and adjust for that today. And so we adjust for all of that. And when you put all of these in, even though they started at, in this example, $5,000 a month of rent on a $1.1 million property, when you factor in the vacancy, turnover costs, all of those other expenses, in this example, they're getting a yield on equity of 4.28% and a cash flow, meaning what they can actually spend, of 2.81%. And this is very common. When I ask people to sort of estimate what they think their cash flow is, they often think it's 6%, 7%. But when we run the numbers, it's often in the 2% range. And so when they see this, when they realize that their return on their investment is not as good as they thought it was, on top of the fact that there's burdensome regulation and rent control and all these other problems, it really motivates them to want to sell. I won't go through it because of time, but we have a very similar questionnaire so we can estimate what their taxes are going to be. If they say, I work with a financial advisor who's great and they can get me 12% per year or 10% per year, or whatever they think their financial advisor can get. Well, great. Let's look at this property and see if we were to sell the property today and pay the taxes. What would that look like if you invested the net amount, not even doing a 1031 exchange, just sell it, pay the taxes, and put the net amount with your financial advisor? What is that going to look like? And where do you make up? And so you can do these types of analyses for the clients to help them make a financial decision that's right for them. This really helps you as a real estate professional set yourself apart. Again, we do these analyses every single day. If you prefer to have us do it, we're happy to do it. But if you want to do it with our support, or if you don't need it, you can do it on your own. That's really going to help you solidify the relationship. And then the final thing that you need is the team. I think I closed the window. So if you're going to get into this business, you need a great team that you can depend on. You need people on speed dial that you could pick up the phone and call and say, here's the situation. What does this mean? Is this 1031 exchangeable property? What are the options? What do the fees look like? Whatever question you or your client have, you need somebody that you can go to. That is the support that we provide. We answer questions all the time over the phone. We sit and talk to clients. But also you need a great qualified intermediary, an exchange accommodator, because they're the ones that hold the funds. They're experts at knowing sort of the ins and outs of how all the taxation works. And having a good advisor like us and a great qualified intermediary allows you to step into this market and really go to a place where the demand is much higher and the competition is much lower than the residential market that most people are working in most of the time. Let's see, I see a question here. Let me read this real fast. Average ROI for the past 10 years. Thank you. So I've got one question, and that is, over the past 10 years, what is the average ROI? What kind of returns are we getting here? And I'll tell you that I'll give you an average over the broad market, but every DST is different, just like any investment. And so when you invest in the type of property you're investing in and what part of the country it's in, it's a different answer for every individual investment. But if we look at long-term averages, the average annual return for these historically has been about 10% per year. And that 10% is comprised of cash flow and depreciation. So when you add both of those together, it's been about 10%. If we look at the market today, which I think is most relevant, we see that cash flows net to investors after all the expenses are paid are in the 4 to 6% cash on cash range. So if I invest $1 million, I'm expected to receive anywhere from $40,000 to $60,000 a year paid in monthly payments throughout the year in the first year. As rents go up over time, my cash flow can go up. As the value of the property goes up, my investment amount is also going up. And of course, these are not guaranteed. These are based on the performance of whatever property or properties you're investing in, just like any other real estate investment.
I have a quick question.
Yeah.
Well, first, if everybody can hold on after this presentation, we do have one other quick presenter real quick for some solutions on digital business cards. He just wants to chat for about 10 minutes or so with his product. But my question is, so a lot of, landlords, they own their properties in a trust or an LLC. So they go to sell this thing and put it into a DST. Are they purchasing into that DST through that LLC or in the name of the trust as well? And then what does that look like when they eventually pass away and the property needs to go to the heirs?
Yeah, great question. So any way that somebody can hold title to property, they can hold title to a DST. So very, very typical for people to come to me and say, I'm selling my property. It's in a trust with my wife. We are the trustees of our trust. They sell it in the name of their trust, and they would purchase the DST in their trust, exactly the way they would any other replacement property. If somebody has an LLC for a property, they can buy the DST in their LLC if they want to. But usually the reason they created that LLC is for liability protection. So if somebody slips and falls at the property, they can't, take their home and all their other assets. DSTs have built-in liability protection. So you already have that layer of protection. So you don't need the DST, you don't need the LLC for that purpose. Now, some people choose to keep it because it's part of their overall estate plan and they hold other assets in there. So you can if you want to, but you don't need to. In terms of the inheritance planning and estate planning, sometimes people call me and the primary reason they're selling their property and going into DSTs is because they're planning their estate. They're planning for their children to inherit property. And a really common situation is, well, I have one building worth $5 million and I have 3 kids. And if I pass away and I leave that building to them, they're going to be at each other's throats because one wants to keep it, one wants to sell it, one doesn't care, and they're in Europe all the time, and it's going to create a massive problem. Well, if the parent there sells the property and puts it into DSTs and they pass away, the one that wants to keep it can keep it. The one that wants to sell it can sell it. The one that's in Europe is just going to get the cash flow. So there's not a need for immediate action when they pass away. It's easily divisible for inheritance and estate planning purposes.
And would that look like it's not looking like a buyout at that point, right? So like if in that scenario right there, 2 wanted to keep it and 1 wanted to sell it, the other 2 essentially could buy out that third person on a typical apartment building or single family home or whatever that got left to them. But on the DST, it sounds like maybe that third person that wants to sell would just sell their portion and the other 2 wouldn't be affected, or do they need to buy out?
There's no need to buy out. Yeah, the way it would work is the parent is assuming the trust is set up this way that says, all right, this asset worth $5 million is going to be divided equally among these 3. So when they pass away, somebody from the estate calls us and each of them sign a form, and then we change title to one third, one third, one third. Now they each have their own asset. They all own the same DST, but it's their individual ownership. So they can act in isolation without the approval or cooperation of the other two automatically. They don't need to buy each other out. They own different investment. They own different assets altogether, even though they all own the same DST property.
Yeah, nice. That sounds kind of like a no-brainer if you're doing
Yeah.
estate planning. So, because I'll tell you what, nothing is easy when you're dealing with the heirs and you have, that one that wants to sell or they won't budge on price or they want to move into it or whatever,
Right.
and they just become a nightmare. I tell people all the time, nothing destroys friendships and family like real estate. You know?
It's amazing. And I'm working on a case right now where it's two sisters that own the property. So each of them have their set of children. So you think it's bad enough, disagreeing with your siblings, your cousins, it's like, forget it. And so by going into the DST, it simplifies that whole process.
Yeah,
Nobody has to even talk to anybody else if they don't want to. They got their own share of that DST property, makes inheritance planning really simple.
yeah, that sounds great. So, all right. Well, if there are no more questions,
Well, let me just wrap up, but hopefully you
yeah,
can still see my screen,
yep, we
Travis.
can still see your screen. Yep.
Okay. If you want a copy of the book, How to Retire from Being a Landlord, or if you want a couple copies, email us at info@1031capitalsolutions.com. All the resources that I talked about on my website, 1031capitalsolutions.com. If you want the software, you can register for free. Just go to exchangeillustrator.com. There's a sign up button, and you can access it. 5 minutes from now, you have it. If you play around with it and you don't really know how to use it, give me a call. I'm happy to walk you through it. If you're the kind of person that doesn't want to do that, you want us to do all that, we're happy to do it as well. But all those resources are available to everybody on this webinar today. Yeah.
Nice.
Thank you, Travis.
I'm gonna let Wu come in, but there is a question in the Q&A, and then there's another one the in the chat if you want to grab those while Wu starts up here. Um, yep, okay. So, all right, Wu, are you there?
Yes, sir. Good
Yeah.
morning, everybody.
Good morning. How's it going?
That was a great presentation, Jason.
Thank you.
Let's
All
see.
right.
All
Let me
right,
share
there
my
we
screen here.
go. All right, good to have you back, Wu. Let's see, I think you came in on a webinar maybe about 6 months ago with us, and we've grown since then, and we have new people on the webinar, and so they don't know who you are or what you do. So,
Oh, okay. Well, Travis, it's good to see you again. Yeah. Hello, everybody. My name is Wu. I'm your digital business card guy. Just a real quick introduction about me. I'm not some marketing guru or like a sleazy salesperson. I'm an engineer. I graduated from Cal State Fullerton and I had a senior design project, and that is digital business card to make your lives easier. So I have a quick presentation for you guys this morning. Maybe take 5 to 7 minutes. And so let's go through them. It'll help you up your marketing game. That's for sure. So with that being said, let's get going. All right. So question for everybody in this webinar is who here is giving out business cards but feel like most cards get lost or forgotten? I can't see everybody, but usually when I ask this question, everybody nods their head. Right. So problem with this business cards is this is how 90% of salespeople across all industries network. Hey, my name is Wu with XYZ Realty. If you're looking to buy or sell, I'd be happy to be of your service. Hey, here's my business card. Take this. Please give me a call anytime you have any questions. And we walk away. What happens to your card when you hand it out? 90% of the time is they either number one, throw it away, or number two, put it in the drawer with hundreds of other business cards. And we all do the same thing. Right. And so we can't really tell what our prospective customers will do when we just give them our card. Yeah, they may have our phone number, our email, but that's really it. So here's a better way to connect with modern consumers, and that is using digital business card. It'll look like something like on the left, and it has your picture, your logo, your websites, and your popular visited websites like Google, Zillow, Yelp page or whatever you name it. All your social medias are already in there, your listings, your testimonials, everything in one platform is in your digital business card. Well, so, Woo, I've seen free digital cards before. Why should I pay for one, or how is this different than other cards? That's a great question. Our cards, LinkMe cards, connect directly to your CRM database, whether you use LionDesk, FollowUp, Salesforce, Lofty, you name it, right? And the best part is, like I did for many Rise Realty agents, if you don't currently have a paid CRM database, we actually provide you with a simple spreadsheet. That way you can see everybody you connected with on one platform. That's our value proposition to you guys. So how do you share this card? On the far left is my favorite method is I actually like to text my card over to people. They just click on it and your card will open up on their cell phone. The second image is a team leader of a real estate firm called Palacios Realty. And what he does is he actually puts his digital business card in his social media bio. This is Instagram, and he puts it there. And every time he posts a piece of content, he will say, grab my business card, link in bio. That's an awesome way to share your business card more. Third way is using a QR code. Hey, just scan this QR code and you'll get my card. And because you get a QR code, a lot of our agents like to put it on their listing signs, mailers, open house flyers, or any type of flyers across all your marketing materials. Put your digital business card there in terms of QR code. So, what's in it for you? This is what will happen as a result of using digital business card. So on top right, you can see that it's the date in the month of, so this is one of our clients. In the month of December alone, from December 1st to December 31st, this lady, Stevie, had shared their card over 540 times. And you can see on average, they stayed in on for about 9 seconds, what buttons they clicked, what devices they logged in from, and let's see, her most users or referrals came from her social network, in this case Instagram. You can see where they came from, what time of the day they're looking at your card, or what days of the week they're looking at your card. So your card will actually give you insights on when the best time is to market to your prospective clients. And so check this out. According to NAR, on average, agent shares her paper business card or their paper business card roughly 34 times per month. Now that's the average. So half the people are sharing way less, half the people way more. But agent A, let's just say, is sharing paper business card. By the end of the year, this agent can share their card 600 times. Okay. Let's look at agent B that's using digital card. Per month, you just saw that you can share this card well over 500 times per month. By the end of the year, agent B using digital had shared their card over 6,000 times. And so let me ask you a question here. After 3 to 5 years of going digital every single year, if you're able to share it 10 times more than an average agent, these two agents are not even in the same stratosphere in terms of their outreach to their prospective clients. They're not even in the same game because agent B is sharing their card 10 times more. So if you can share your card 10 times more, do you think it'll help you get one extra listing or one extra deal, one extra buyer client per year? I'm positive because it has so for a lot of our clients. So I'm going to play one video and I'm going to hop up the stage. And here's a video just kind of summarizing what agents say about our digital business card.
And I presently don't have a business card. And even when you give them a business card, I mean, people give me business cards and I really want to use their service and I can't find it.
Because what LinkMe is a digital business card. Essentially, I don't have to carry a business card.
Makes the agent being perceived more professional. First impression. It helps building first impression.
They enter their first, last name, their email address, their phone number. They get all my information. Their information goes directly into my CRM.
You get contact information all the time at open houses and whatnot. And I think it's really important for an agent to schedule that time to make sure it's in the CRM, they're updating data, but to have the card do it for you, that's awesome.
Anything that can help me get organized like this and get my contacts that I need to do business with on one platform, This is awesome.
He's even added a little spot on there for review me now. So if you want to build up your Zillow reviews or you want to build up your Google reviews if you're in real estate, it is an amazing tool.
And it saves me time. It saves me, having to research and figure it all out. You made this so easy for me, honestly, Wu, that it just, how could you not do this?
We are big fans.
Okay, well, Wu, how much are you going to charge is usually the next question that I get. That's a great question. So here's the pricing. So we have one simple pricing here, and that is $12.50 per month billed yearly. It's less than a cost of Netflix subscription. And because I'm confident that it will add value to your business, if you genuinely don't see value in this within 30, 60 days of your, using digital, contact us and I'll be happy to give you your full money back. And so there's no hidden fees. If you'd like to move forward, simply scan this QR code. I'll also drop a link in the chat that you can use for those people that are using your cell phone to view. So that's all I got for you guys today. I hope that this can help you close more deals this year in 2025. And Travis, thank you so much for having me today.
Yeah, thanks for coming back. And I definitely recognized at least one of those agents in that video. So I talk to him all the time. And he does love the card. So, and this is, a really good solution. I tell people all the time that are, doing mailers and things like that, you got to get them from print to digital, right? So the more ways that you can get that consumer into your digital database, the better you can market to them, as the years go on. So this is a good solution for that. You're getting your card or your contact onto their phone and vice versa. You're seeing, who's retaining your card as well. So yeah, great presentation. Thanks for coming on again. I'm sure we'll have you back because we continue to grow and they want to know where to get digital business cards. So I usually send them over to you. So
let's do it. Sounds like
all
a
right.
plan. Well, happy Monday, everybody. Thanks for having me. Talk to you next time.
Awesome. Thanks, guys. Thanks, everyone, for attending today. Jason, that was awesome. Thank you. And hope everybody has a great week. Let me know if you need anything. We'll talk to you soon.
See you guys.
Bye-bye.